Did you know that Fortune 500 companies are sitting on over $2.6 trillion in cash reserves, yet the average employee wage has barely budged in years? It's a perplexing reality affecting millions. Today, we're diving deep into this paradox to uncover why companies with abundant cash still choose not to pay their employees more. Welcome to the Money Mentor Hub. With extensive experience in financial analysis and corporate strategy, we're uniquely positioned to explore this complex issue. We've analyzed countless balance sheets and spoken to industry insiders to bring you insights you won't find elsewhere. In this video, we'll unravel the disconnect between corporate wealth and employee compensation. Stay with us as we explore the reasons behind this phenomenon, discuss the delicate balance between financial strategy and employee satisfaction, and reveal compelling case studies that might change your perspective on big business. Plus, we have an eye-opening insight toward the end that you simply can't miss. Let's set the stage. Despite record-breaking profits and swelling cash reserves, many companies aren't sharing the wealth with their employees. Wages remain stagnant and bonuses are scarce. This isn't a minor issue. It's a significant concern impacting workers' livelihoods and the broader economy. So, what's the central issue? Despite ample funds, companies often choose not to allocate money for pay raises or bonuses. This decision is influenced by a web of factors we'll dissect today. One primary reason is shareholder expectations. Companies face immense pressure to deliver short-term financial results. Shareholders often prefer stock buybacks or dividend payouts over increased wages because these actions can boost stock prices and provide immediate returns. Another factor is profit reinvestment. Companies may opt to channel cash reserves into research and development, acquisitions, or expanding into new markets. While these strategies aim for long-term growth, they often come at the expense of employee compensation in the short term. Market competition also plays a role. In industries with thin margins, companies might hoard cash as a buffer against economic downturns or to outpace competitors through aggressive pricing. This cautious approach can make them reluctant to increase fixed costs like wages. But here's where it gets interesting. The most compelling insight is the balance between financial strategy and employee satisfaction. Neglecting employee well-being can lead to higher turnover, lower productivity, and a damaged reputation, all of which hurt the bottom line. Consider Company X, a tech giant with billions in cash reserves. Instead of increasing wages, they focused on stock buybacks. Soon, they faced a talent exodus as employees left for competitors offering better pay. The cost of recruiting and training new staff exceeded what they would have spent on wage increases. On the flip side, Company Y invested a portion of its cash reserves into employee bonuses and development. The result? Higher employee satisfaction, increased productivity, and greater profitability. Investing in employees proved to be a win-win. But what about the long-term implications? Stick around because we'll delve into how this disconnect could impact the future of work and what it means for you. Psychological factors are also at play. Executives may prioritize projects with immediate returns, overlooking the less tangible benefits of employee satisfaction. There's also the issue of wage compression. Raising wages for some can disrupt internal pay structures, leading to dissatisfaction among other staff. Globalization allows companies to outsource labor to countries with lower wages, diminishing the incentive to raise wages domestically. Additionally, tax policies can influence decisions. Retaining earnings might be more tax efficient than increasing wages, leading companies to stockpile cash in anticipation of tax changes or economic shifts. But is this strategy sustainable? Can companies thrive while neglecting employee financial well-being? We'll tackle this critical question shortly, so keep watching. Public perception plays a crucial role. In the age of social media, companies are under intense scrutiny. Those seen hoarding wealth while underpaying employees risk backlash from consumers and advocacy groups, harming their brand image. Some companies try to mitigate this through corporate social responsibility initiatives, but critics argue these efforts don't replace fair employee compensation. Should companies prioritize philanthropy over paying their employees better wages? Employee morale is deeply affected when workers see employers accumulating wealth without corresponding pay increases. This can lead to decreased motivation, lower productivity, and a decline in work quality, eroding the company's competitive edge over time. Employee dissatisfaction may also result in increased unionization efforts or strikes, causing costly disruptions. So, what can be done? Companies need to recognize that investing in employees isn't just ethical, it's strategic. Redirecting a portion of cash reserves toward better wages and benefits can foster a more engaged and productive workforce. Transparent communication about financial strategies can build trust between management and employees. When workers understand the company's long-term goals and how they fit in, they're more likely to be supportive, even if immediate wage increases aren't feasible. But here's the twist. Some forward-thinking companies are already making these changes and reaping the benefits. Look at Company Z, a retail firm struggling with high turnover and low customer satisfaction. By investing cash reserves into employee wages and training, they saw dramatic improvements in service and sales. The initial costs were quickly offset by increased revenue and reduced hiring expenses. This shows that the relationship between cash reserves and employee wages isn't zero-sum. Investing in employees can yield positive returns, benefiting both the company and its workforce. As we approach our conclusion, let's recap. Despite significant cash reserves, many companies choose not to increase wages due to shareholder expectations, profit reinvestment, market competition, and tax considerations. However, neglecting employee compensation can lead to negative outcomes like reduced productivity and a tarnished public image. Conversely, investing in employees often enhances performance and profitability. The disconnect between cash reserves and employee pay is complex with far-reaching implications. It's a balance that requires thoughtful strategy. So, where does this leave us? If you're an employee, understanding these dynamics can empower you to advocate for better pay or seek employers who value their workforce. If you're an investor or business leader, it highlights the importance of considering employee satisfaction for long-term success. We'd love to hear your thoughts. Do you believe companies should allocate more of their cash reserves to employee wages? Have you experienced this disconnect firsthand? Share your insights in the comments below. If you found this discussion valuable, please give this video a thumbs up and consider subscribing to the Money Mentor Hub. We're committed to providing in-depth analyses to help you navigate the complex world of finance and business. Before you go, check out the video appearing on your screen right now. It explores innovative corporate financial strategies that could reshape the future of business. Trust us, it's a must-watch for anyone interested in understanding the evolving economic landscape.